What's up, traders? It's Wednesday, October 15th, and we're watching one of those classic split-screen markets right now. On one side, small caps are absolutely ripping. The Russell is up nearly 4% this week. Banks crushed earnings. Chips are rallying on AI hype. The surface looks beautiful. But flip the channel, and you will find out that smart money is quietly dumping tech into this rally. VIX is climbing. Dark pools are lighting up with institutional selling, and we've got massive economic data dropping tomorrow that could completely flip the script. It's like watching a highlight reel while the coach is already reviewing tape for what went wrong. Let's break down what's actually happening beneath the surface, what's coming the rest of this week, and where the real trade setups are. Small caps are the story of the week. The Russell is outperforming everything, which tells you two things. Risk appetite is back, and money is rotating out of megacaps into growth and value plays that got beaten down. Monday kicked off with a risk-on surge after the White House softened its rhetoric on China. That's classic geopolitical relief rally behavior. Tensions ease, money floods back into risk assets. Chip stocks and mining names caught a bid. Then we got buzz around a Broadcom-OpenAI AI chip partnership story, and semiconductors ran hard. It felt like early 2024 all over again when every AI headline added 2% to the Nasdaq. Tuesday and Wednesday, the catalyst shifted to earnings. Bank of America and Morgan Stanley both beat expectations. Solid numbers, strong guidance. Financials ripped. Then this morning, ASML, the Dutch semiconductor equipment giant, dropped better than expected order numbers. That's a leading indicator for chip demand, and the market took it as confirmation that AI spending isn't slowing down. So financials and tech have been tag-teaming this rally. Meanwhile, the Fed released its Beige Book today. That's the regional economic snapshot they put out before policy meetings. Fed speakers have been all over the airwaves, especially Atlanta Fed President Raphael Bostic. They're threading the needle right now, trying to balance growth optimism with sticky inflation concerns. Markets are still trying to figure out if we're getting a soft landing, or if the Fed's going to have to stay higher for longer. It's like watching someone parallel park a truck. Everyone's nervous, but so far they haven't hit anything. And then there's geopolitics. US-China trade headlines are whipsawing this market intraday. When the tone softens, we rally. When tensions flare up, we dump fast. It's exhausting, but it's the reality of trading in 2025. You have to stay nimble. My trades this week. I scalped NVDA 192.50 calls on Tuesday. Bought them at 45 cents, closed at 55 cents for a quick 22% gain. I wasn't trying to be a hero. Took profit and moved on. Also grabbed Apple 240 puts at 95 cents. Rode them to $1.15 and closed for about a 21% gain. Apple's been heavy, and I wanted to catch that move. I'm still holding NVDA 207 calls that I bought at 18 cents. I'm letting that ride into Friday to see if TSM earnings tomorrow confirm this chip strength, or if we start seeing distribution. Right now I'm up, but I'm watching closely. If smart money keeps selling tech like they are today, I'll cut it before the weekend. Tomorrow and Friday are stacked with market-moving events. This isn't a slow drift into the weekend. This is where the narrative for next week gets written. Let me walk you through what actually matters. Thursday, October 16th. At 8:30 a.m. Eastern, we get three major data points dropping simultaneously. First, the Producer Price Index. That's your wholesale inflation check. If PPI comes in hot, it tells the Fed that inflation is still in the pipeline, even if consumer prices have cooled. That keeps rate cuts off the table. Second, retail sales for September. This is the big one. Consumer spending is 70% of the U.S. economy, so if this number is strong, we get growth optimism. But it also raises inflation concerns because strong demand keeps prices elevated. If it's weak, we get dovish Fed bets, but recession fears creep in. It's a Goldilocks situation. Markets want it just right, not too hot, not too cold. Think of it like checking your bank account after a weekend in Vegas. You either feel great or you're immediately recalculating your life choices. Third, we get weekly jobless claims and the Philly Fed Manufacturing Index. These are secondary, but they add color to the labor and manufacturing picture. For earnings, Taiwan Semiconductor reports before the bell, and this is massive. TSM is the foundry for Apple, NVDA, AMD, basically everyone in AI, and chips. If they confirm strong AI chip demand and guide up, semiconductors could run another 5 to 10% this week. If they disappoint or sound cautious, Chips get sold hard and drag the Nasdaq down with them. This is the linchpin for tech sentiment heading into Friday. After the close Thursday, we get Schwab and CSX. Schwab is your retail trading and wealth management bellwether. CSX is rail and logistics, tells you if goods are actually moving or if the economy is slowing. Both worth watching. The Atlanta Fed is also hosting its annual employment conference Thursday and Friday, so expect more Fed officials commenting on the labor market. Any hints about November's policy move will move bonds and equities. Friday, October 17th. At 8:30 a.m., housing starts and building permits drop. This tells us if construction and housing, which have been surprisingly resilient despite high rates, are finally rolling over. Housing is a leading indicator for consumer confidence and big-ticket spending, so if this cracks, it's a warning sign for Q4 growth. At 9:15 a.m., we get industrial production and capacity utilization. That's your hard read on manufacturing and factory output. If this is weak, it confirms the economy is decelerating. If it's strong, it supports the soft landing narrative. Before the open Friday, American Express reports earnings. AXP is your credit card and consumer health barometer. If spending on Amex cards is strong, it backs up the retail sales narrative. If it's pulling back or delinquencies are rising, that's your canary in the coal mine for consumer stress. Bottom line for the rest of the week. Thursday's retail sales and PPI will set the tone. TSM earnings will either fuel the chip rally or kill it. Friday's housing and manufacturing data will confirm whether the real economy is holding up or starting to crack. We're at a pivot point. The data will decide if we end the week green or red. Don't front-run it. Let the numbers hit, then react. New trade idea. For the next 2 days, I'm watching Wayfair, ticker W. And here's why this setup is interesting. Current price is sitting around $80 to $85, and Thursday's retail sales data is the perfect catalyst for this name. Wayfair is furniture and home goods, discretionary spending. If retail sales come in strong, especially in the goods category, furniture stocks could pop hard. It's a direct read-through. Let me walk you through the technical setup. The chart is forming a base after some consolidation. It's not breaking out yet, but it's coiling. RSI is sitting in the mid-50s. Not overbought. Plenty of room to run if we get a catalyst. MACD is showing a bullish crossover, which tells you momentum is shifting positive. The volume has been spiking on up days, which is exactly what you want to see. Accumulation, not distribution. I've also noticed some unusual call flow coming into Wayfair this week. That's often a tell that someone with more information than us is positioning ahead of a move. It's like seeing the smart kid in class start studying early. You pay attention. Here's the trade. Entry. Above $82. I want to see a breakout above recent resistance with volume confirmation. I'm not guessing. I'm waiting for the move to prove itself. Stop. $78, right below recent support. If we break that level, the setup is invalidated, and I'm out immediately. No hoping, no bag holding. Target, $88 to $90. That's roughly 7 to 10% upside over 2 days, which is a solid risk-reward for a swing trade. Hold duration. Through Friday close if Thursday's retail sales data confirms consumer strength. If the data disappoints Thursday morning, I'm cutting the position at open. This is a data-dependent trade, not a conviction hold. This is a catalyst-driven swing setup. I'm not forcing it. If retail sales miss expectations or come in weak, this trade doesn't exist. But if we get confirmation that consumers are still spending, Wayfair could rip into the weekend as traders position for a stronger Q4 retail outlook. Let's talk about what the institutions are actually doing while retail is chasing the rally. Dark pools. Today we saw a massive $345 million block trade in SOFI at $27.87. That's not retail clicking buy on Robinhood. That's an institution quietly positioning size. When you see prints that large, someone knows something. Or they're making a big macro bet. Dark pool volume, overall, hit 37.3% of total market volume today, which is elevated. That means a lot of institutional trading is happening off-exchange, away from public eyes. It's like watching someone buy out the back room of a store while everyone else is shopping the clearance rack up front. Options flow. There are bullish sweeps showing up across multiple names, which signals institutional buying interest. But here's the major red flag. NVDA saw 1.2 million shares of dominant sell pressure today. That's not profit-taking, that's distribution. Tech, which has been the leader all year, is now seeing the most institutional selling. It's like watching the DJ leave the party early. Maybe he knows something you don't. VIX, sitting at 20.81, up over 9% from Monday's level. Volatility is rising even as the market grinds higher. That's a warning sign. Usually when markets are healthy and trending up, VIX falls. When VIX rises alongside the market, it means there's nervousness, hedging, and uncertainty beneath the surface. It's the financial market equivalent of your check engine light coming on while you're still driving fine. It's not a problem yet, but it's about to be. Put/call ratio. The SPX put/call ratio is sitting at 1.31, which is elevated. That means more puts are being bought than calls relative to normal activity. Institutions are in protection mode. The equity-only put/call ratio is lower at 0.49, so there's some mixed sentiment, but the institutional tilt is clearly toward caution. When big money starts buying insurance, you pay attention. Market mood. Right now, sentiment is shifting from greed to mild fear. Institutions are selling tech into strength, VIX is climbing despite a green week, and put/call ratios are elevated. This rally feels fragile, like it's built on hope and momentum rather than conviction. It's the difference between a packed stadium for the Super Bowl versus a packed stadium where everyone's checking the exits. What to avoid? Fade tech for the rest of the week, especially mega-cap names like NVIDIA, Apple, Microsoft. They're seeing the clearest institutional selling despite the surface-level rally in semis this morning. Even with the ASML news and TSM earnings tomorrow, smart money is distributing shares into the hype. Don't chase overextended tech longs right now. If you're in tech and sitting on profits, consider trimming or taking some off the table before the weekend. Wait for a pullback or a clearer signal before adding new exposure. Also, avoid chasing small caps at these levels. Yes, IWM is the leader this week, but up 3.7% in 3 days is a big move. If economic data disappoints tomorrow, small caps will give back gains faster than large caps because they're more economically sensitive. Don't chase the move. Let it cool off and find an entry on a dip if you want exposure. Alright, here's your midweek summary, and this is what you need to lock in before tomorrow's open. We've had a strong run since Monday. Small caps are leading, banks crushed earnings, chips are rallying on AI optimism, and risk appetite is back in the market. But we're at a major inflection point. Tomorrow's retail sales, PPI, and TSM earnings will decide whether this momentum continues into the weekend or whether we roll over and give back the week's gains. I'm watching Wayfair for a quick swing trade if retail sales data supports the consumer spending story. I'm still holding my NVDA 207 calls from 18 cents, but I'm on high alert. Smart money is selling tech, VIX is rising, and we're seeing institutional distribution beneath the surface. If TSM disappoints or economic data comes in weak, I'm cutting that position fast. Stay sharp this week. Don't chase moves that have already happened. Don't front-run data. Let the market show its hand, confirm the direction, then position accordingly. The best traders aren't the ones who predict what's going to happen. They're the ones who react correctly when it does. Drop a comment below with what you're watching or trading the rest of this week. I want to hear what setups you're tracking. Hit that subscribe button if you want daily market breakdowns like this. No fluff, no hype, just real data and real trades. Trade smart, stay disciplined, manage your risk, and let's get it.